One of the most basic principles of investment management is to incorporate diversification into your investment strategy. But how do we build a diversified portfolio, and why should we? Welcome to another episode of Money Matters. In asking why we want to build a diversified portfolio, modern portfolio theory introduces the concept of mean variance optimization. This is a fancy way of saying when two assets have a similar long-term performance, but in the short term they move in opposing directions to each other. The benefit is that when you hold both these assets, their short-term movements largely cancel each other out. So, in theory at least, you not only benefit from long-term gains, but also along the way, you need not worry about market fluctuations. When their movements oppose each other, we say that these assets are negatively correlated. As an example, let's say an investor holds stocks in a company that sells winter coats. The bulk of its sales occur in the run-up to winter. The stock price, in this example at least, drops as the sales falls in summer, but recover in winter. Its stock price is volatile. To manage the short-term volatility, the investor decides to invest in a company that sells summer shorts. This company's stock price has an opposite pattern, in this example at least, where it rises in summer but falls in winter. These two stocks are negatively correlated. The investor will still benefit from long-term gains, assuming that both companies continue to grow and expand, but the short-term fluctuations of these two stocks cancel each other out. This is mean variance optimization, a benefit of diversification. Whilst that's the theory, in practical terms, it's not that simple. Who actually just holds two stocks? But you can apply this theory when assessing your own portfolio. In terms of sectors, if your portfolio is overly heavy with tech stocks, your portfolio will be at the mercy of tech stocks' performance. In terms of regions, if your portfolio is overly heavy in US stocks, again, your portfolio will be at the mercy of US stocks' performance. The easiest way to ensure diversification is to buy a bit of everything and track the global markets. How do we do this? You can consider the MSCI All Country World Index, or the S&P Global 1200, or the FTSE All World Index as a few examples. Does this mean you have mitigated all market volatility? No. There are events that affect the whole world no matter how broad your positions are. Take the pandemic last year, when global stocks plummeted in March. Even with the example of the investor holding stocks in companies selling both winter coats and summer shorts, it is more than likely that sales of both would have plummeted too, and its portfolio's value would have fallen accordingly. And that's okay. Market risk or volatility is inherent with investing in the financial market. You just have to accept it. And remember that financial markets will always eventually continue to rise. You can see a video on this topic by clicking here. This means that your portfolio is almost guaranteed to perform given enough time. When we look back at the pandemic, the S&P Global 1200 fell approximately 34% in the space of 35 days. But then it took 156 days to recover back to the same level, and continues in strong form from there. However, portfolio construction and building in diversification is far more in-depth than simply tracking a global index and forgetting about it. Indices can be very top-heavy, so whilst the number of constituents may be many, the weighting may be mostly in the top several constituents. Just look at the S&P 500 here, where the top 5 have a weighting that is over 20% of the index. That's the top 1% having 20% of the market capitalization of the index. You may consider mutual funds, which although have fallen slightly out of favor in recent years, due mainly to the lower cost of index tracking ETFs, have some advantages. It is true that the majority of mutual funds underperform their benchmark or the equivalent index, but that also means that some outperform, and the trick is to identify these outperformers. It is important to avoid the closet index tracking funds. You might as well buy the equivalent ETF and save on the significant management fees. Instead, look for funds which have a higher conviction strategy, meaning it doesn't have too many holdings and is more concentrated. This shows that the fund manager and his team have carefully built a portfolio that they believe will perform, and also usually avoids the issue of top-heavy index tracking ETFs. Note that diversification does not mean buying companies or investments that no one's heard of. You don't need to buy stocks of a firm that sells a niche product in a niche sector to a niche demographic. It's perfectly fine to buy the companies that everyone has heard of. Just think of Apple, for instance. These mega corporations will indirectly build diversification into your portfolio in that its income streams are global, its product range is vast, meaning that it doesn't rely on one product. Thus, this is another form of diversification. You can choose from several different asset classes, including cash, bonds, property, equities, and commodities. The value or price of these different asset classes may oppose one another. They are negatively correlated. For example, it has long been thought that gold is a safe haven asset and is largely negatively correlated against the stock markets. When stock markets fall, gold historically has shown to rise in value. Whilst many investors try to outperform the markets by timing in and out, but ultimately failing, many would actually generate very satisfactory returns simply by using a globally diversified portfolio. Some investors don't believe me when I say that you can expect double-digit returns by investing passively in a well-diversified portfolio. But here you can see the S&P Global 1200 generating over 12% per annum over the past 10 years. Yes, it's true that your platform or product wrapper will cost you some of this return, but it's very reasonable to aim for a growth rate in the double digits. The trick is to think long term, and most investors have a long investment time horizon anyway, whereas most other market participants have a short-term time horizon. Investment banks, traders, and speculators in general all care about the most current financial news and are concerned with the latest market sentiment. We investors need not be overly worried about the daily market movements, and it's easy to be lured into the market sentiment. Remember, we investors usually have a far longer term investment time horizon and can ride out the troughs in the market, and it's usually in our best interest to wait it out. As John Maynard Keynes once said, a market can stay irrational much longer than an investor can stay solvent. Investors may decide to build in some defensive strategies that really come into their own during an economic downturn. These may include steady performers like the healthcare sector or consumer staple sector, which produce stable profits through all phases of the economic cycle. Portfolios should be tailored to the investor's circumstances and financial objectives. There is no one size fits all. And we must never forget, a portfolio made today may not be relevant in the future. Investment strategies and thus portfolios must adapt to changing market conditions and evolve with the investor's dynamic needs. Never buy and forget. Whatever investment journey you are on, ensure you have built diversification into your portfolio. Remain diligent, but remain steadfast. And get as much invested as soon as you can. Financial planning and wealth management is about tailored preparation in accordance with your specific goals to secure you a brighter future. It requires hard work and persistence. And if it's all too much to handle or you prefer to delegate, do get in contact in the link below to find out how we can build you a bespoke strategy for your financial future. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in the future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.